Welcome to the Pitch Partners client webinar, unpacking everything you need to know about year-end tax planning. Thank you for joining us. I'm Chanel Palmer, Client Director in our Tax Advisory Group here at Pitch Partners. Joining me today are Yina Tang and Greg Nielsen, both of whom are partners in our tax advisory team. Yina has an accounting and a law background and has worked with clients across a range of industries, including logistics, property, and financial services, to name a few. She has a strong technical expertise in advising in income tax in Australia and taxation aspects of business structuring. Greg is similarly also qualified as an accountant and lawyer, specialising in providing tax advice to Australian corporates, large private groups, along with high net worth individuals. Greg brings over 27 years of tax experience to today's discussion. Thank you both for joining me today. We'll be using Slido to take questions and run polls in today's webinar. On your screen, you'll see a pop-up message inviting you to join. All you need to do is click the open button. If you've got any questions, please submit them in Slido as we go. Now, I know it's been a busy couple of weeks for everyone, particularly coming off the back of budget and 15 May. But as we head towards the end of May, attention now starts to turn towards the year-end tax planning, and that's a good time to take a sort of step back and reconsider what we're doing. When people think about 30 June, they sometimes focus a little bit too much about just bringing forward tax deductions, but obviously year-end tax planning is a lot broader than that. At its core, it's about making sure you optimize your position for this year while also putting in place the structures, documents, and decisions to optimize your position for next year as well. So with that in mind, let's jump towards some of the questions. Yina, we'll start with you first. Starting with individuals, as we head into 30 June, what are the key things that people should be really thinking about and turning their minds to now?
Yeah, no, thanks, Chanel. I suppose from an individual perspective, the first thing that most people normally think about here are things like work-related expenses and working from home expenses. So the thing to be mindful of there is your record-keeping obligations with respect to that. So there is the 70 cents per hour method that is applicable to working from home, but at the same time, you do have to keep your records to make sure that you're tracking when you're working from home, how many hours you're working from home. Substantiation tends to be the thing that most people sort of, I guess, miss, because as we all run up into year end, it's all very, very busy, right? So just be mindful that in addition to working from home expenses, the ATO are actually getting more and more data as well. So we're actually increasingly seeing the ATO having data on things like your cryptocurrency wallets, your cryptocurrency expenses, all your share transactions. So make sure you actually have all of that to hand and understand where they are. The new thing for, I think, individuals this year is that the ATO have recently finalised their view on holiday homes. So that may be a bit of a change for a lot of individuals. Now, that doesn't apply for FY26. So this year is sort of free from those rules, but it's probably a good idea to actually familiarise yourself with those rules to understand what that might look like for you for next year. And similarly, rental property expenses and all expenses really is working out if you need to apportion it, if what kind of, business use or work use that's the asset has been put to, and particularly interest deductibility, making sure that you've considered the purpose for which the funds were put to work out whether the interest is deductible or not.
Yeah. And speaking about work-related expenses, people might be a little bit excited about the $1,000 standard deduction that's available, so they don't have to worry about some of those substantiation expenses.
Yes.
That's not available for this year. Where does that apply from?
No, that isn't available this year. So if that's legislated, then that will apply for next year. But equally, I think I would probably encourage people to actually have a think about that, because for some people that might actually be a boon. Particularly if you're bad at record keeping, like I am, perhaps, personally. But equally, there may actually be better deductions or bigger deductions you can actually claim if you've actually spent more than $1,000. So I don't think it's a get out of jail free card. It's a base, but a lot of people might actually be better off, keeping their records properly.
Yeah. Particularly for things like self-education expenses that can exceed $1,000 very easily.
Definitely.
Super contributions are always a focus at this time of year. So, Greg, what are the practical points that individuals really need to be across?
Yeah, well, firstly, timing is critical.
Always.
Who'd have thought in a year-end tax planning session? But by 30 June, you've got to make sure that your contributions aren't simply made, but they're received by the fund. And that means that it's hitting the bank, it's going through the processing clearing centre. It's got to be received. It's not just a case of pushing the button at the end of the contributor. The other one to keep in mind is if you're looking at your concessional contributions, make sure that you're not tipping over that limit. So we're at 30,000 for 30 June 2026, and those concessional contributions, they include both your employer's contributions, your salary sacrifice, and your own personal contributions that you're making. So keep a track of just how much that is in aggregate, so that ideally you're not going over. And then keeping with concessional contributions, there's also that opportunity to bring forward now. So you can go as far back as 5 years to top up any unused concessional contributions that you may have had available from previous years. It is a limit of 5 years, so it's use it or lose it is the policy. And it does come with another limit. It will look at what your superannuation balance is. So $500,000 is the magic number. So you've got to keep an eye on that as well before you're making the exploitation of that opportunity. For non-concessional, it's the same kind of considerations about timing is everything, checking what the cap is on your balance. As at 30 June 2026, we're still sitting at $120,000. That goes up to $130,000 next year, but $120,000 this year. And then consider, if you've got the available cash, whether you might want to make a bring forward contribution for your non-concessionals as well. So that's the 3-year opportunity where 120,000 could be as much as 360,000 as a bring forward by 30 June 2026.
And you spoke at the start about the importance of the funds being received by the superannuation fund prior to 30th of June. What does that mean?
Well, it means making sure that the actual fund receives the money. As I said at the start, it's not simply about you making that contribution by 30 June. So don't put through the EFT transfer on 30 June. Leave yourself plenty of time. And while I'm careful to make any specific recommendations, perhaps 5 business days is keeping it a bit safer if you do that.
Don't press transfer on the 30th of June at 5 p.m.
59 p.m.
We can't talk about super without talking about payday super, of course. That starts from this 1st of July.
Mm-hmm.
From an employer perspective, what does that mean from businesses, and more importantly, personally, what does it mean for individuals?
Yeah, certainly, I think from an individual perspective, it's a good thing. You get your super a little bit earlier, so you get to start sort of earning money on that in your superannuation fund a little bit earlier than under the current rules. I think for businesses, though, it's a real watch out and making sure that they actually understand their processes for paying super. So Greg just mentioned earlier that it is important that superannuation funds hit the super fund by the requisite time. That's important for individuals, but that's actually also important for the employers as well. They actually have to make sure that that actually happens. So with increased frequency of payments, what you're inevitably going to get is an increased frequency of errors, right? So in the lead up to 30 June, in preparation for payday super coming online, maybe a dry run would be a good idea, just to see, how long it takes for a super once the businesses pay it for it to hit the actual super fund. Equally, it means a lot more cash flow planning for businesses because there will be more outflows more frequently. And then just really critically, just understanding your processes to ensure that it's all going smoothly and that you're not going to hit any hiccups along the way.
I think in an ideal world, you just want it to be a seamless part of your payroll processes at the end of the day and not something separate. And wants to stick together.
Yeah.
I mentioned earlier about bringing forward deductions. So besides buying a printer in June as opposed to July, are there any other legitimate timing opportunities that individuals can take advantage of to either bring forward deductions or defer income?
Yeah, well, thanks for that reminder. I do have to go buy that printer in the next few weeks. But look, for an individual, prepayments are still there as an opportunity. Let's use the most common example, interest expenses, maybe on a business or a rental property, but you must make sure that you are satisfying the requirements under the prepayment rules. So a 13-month rule always needs to be considered in that respect. Apart from prepayments, there's the old faithful bringing forward your donations. But just make sure when you're doing that, that you make sure that they are a deductible gift recipient. Check that first. That's often a mistake. The second one would be make sure that the actual receipt, the donation receipt, specifies the donor correctly. So depending on who is actually making that donation and who's contemplating as to where they get the most bang for their buck in terms of the deduction. Make sure that the donation receipt supports that. Realisation of assets that are where you're sitting on an unrealised loss in a year when you otherwise have made a capital gain. That's a bona fide opportunity for individuals to be able to mitigate their capital gains if they dispose of their assets which are really worthless or certainly worth less than what they paid for them. So as to give rise to that capital loss and therefore offset the capital gain. You just have to be mindful of the wash sale rules in that respect.
Yeah. And what is a wash sale in those circumstances?
Okay, so wash sales is a concept that comes about from avoidance style schemes where somebody will dispose of an asset for tax purposes, realise a capital loss on that asset, but when you step back, they probably haven't really altered their commercial position, their fundamental commercial position. Now, the best example or the most simple example is someone who sells shares on the market and then the next day buys the same shares or at the same time buys the identical shares. So come the end of financial year, they're actually sitting there in exactly the same economic position. They still really own fundamentally those shares, and yet they've been able to realise a capital loss to apply against their capital gains. So the Commissioner came out with a ruling back in 2008 on this, but he raises it every year as part of his things that they're looking out for when individual taxpayers are making decisions.
Yeah, it's a long-standing risk. I think that's been flagged by the ATO, and it's always comes to light when you have things like at the moment you have maybe a downturn in the finances and some of your assets do go down and you have those unrealised losses to offset them.
Look, it can also be a transfer from one individual to another individual who might be a related family member, for example. And so the ATO, again, they're going to be looking out for those contrived arrangements. And that extends beyond wash sales as well. That'll also cover things like deferring income. So deferring income, another opportunity or a valid thing to do at year end, provided there is actually commercial substance behind it. So somebody who is entitled to receive income would want to look at their contract, their service contract, to see whether or not that provides for the point in time when they become legally entitled to that payment. And if the contract's very clear that you're entitled to it pre-30 June, then putting forward some contrived arrangement whereby you actually don't get paid until after 30 June won't necessarily be accepted by the Commissioner.
Absolutely. Moving to trust now, this is always one of the most critical issues for year end. The trustee obviously needs to make a determination as to what the income of the trust is and then how it will flow to beneficiaries.
Yeah.
What's the key message for trustees coming into 30 June?
Yeah, I think for trustees coming into this 30 June, as it is with every sort of 30 June, is really to understand that they do owe fiduciary obligations to their beneficiaries, and that comes with it a whole suite of things that they should really be preparing to do in the lead up to 30 June and really all throughout the year, one of which is primarily read the trust deed, right? It sounds really sort of trite to say, but it is the governing document by which the trustee, all their powers and all their duties sort of come about. So the trustee really needs to understand, what does the trust say income of the trust estate is? What do they actually have to distribute? Who can they actually distribute to, right? Who are the eligible beneficiaries? Who are the excluded beneficiaries of the trust? So all of that needs to really come into play. Another part is we often have corporate trustees, so therefore those duties then fall on the directors of the corporate trustees. And one thing to be mindful of is, in addition to the trustee, you also have the constitution of the trustee company to consider. So what are the procedural requirements that are necessary to make distributions effective? Under the deed, are there any approvals needed from the guardian or from anybody else, the appointor? And under the constitution of the trustee, how many directors need to be there to sign the minute or, undertake or have the meeting together, making sure you actually hit those steps to make sure that the distributions are effective. Distributions are obviously must need to be made by 30 June in each year to be effective. So please be mindful. There are certain instances in which decisions can be made by 30 June and then minuted or recorded and entered into the records of the trustee company within 28 days post that date. So be mindful of that and make sure that if you're looking to avail yourself of that timing, is that you've actually had the meeting and that you've made the decisions that is then to be subsequently recorded. Another thing I'll say is making sure that you actually have the TFNs for your beneficiaries. This is often a really last minute thing that we see in the last week of June when people are, having new beneficiaries and they're like, I don't have a TFN, so we've got to do this mad scramble to apply for a TFN and get it. Be mindful of that, be prepared for that. It can sometimes take a little bit of time to get a TFN, and there is technically a requirement to withhold from distributions if the trustee doesn't have the TFN of a beneficiary by 30 June. So one thing just on the horizon is that mandatory reporting of TFNs for beneficiaries will start to happen as part of the 2027 tax return. So we're not really going to be able to get away from it anymore. But again, that's usually what I sort of see in that last week is everybody madly scrambling to get TFNs done.
And I think the other thing you mentioned about the confirming eligibility of beneficiaries, read the deed, work out whether the beneficiary is eligible, and it really interacts with those procedural requirements, right? Because in some instances, a beneficiary is not eligible unless they've been approved by a guardian or appointer, those kinds of things.
Exactly.
I've seen that time and time again.
Yeah, so just making sure that you're watching all those interactions when you are ticking it over.
And I'll just add to that then is that particularly in Victoria, I'll say, is that we have a lot of trust deeds which for certain estate taxes purposes exclude foreign beneficiaries, right? So those are a real watch out. So certainly what I tend to see, or where I see some mistakes or common mistakes, is where you have a property owning trust and it has those exclusions in it, right, for very legitimate sort of purposes. But then there is another trust in the group that perhaps doesn't have those exclusions in it, and you distribute from one to the other. So that's really something to be mindful of, is if you have trusts within the group with those kinds of exclusions, be aware of them and be mindful about who they can and can't distribute to.
Absolutely.
Yeah.
One area we're seeing an increased ATO focus on in the last 12 to 18 months is on family trust elections. And before we move on, I just want to get a sense from everyone about how many of you are affected by family trust elections. So to understand where the group is at, we've got a quick poll. Does your group or do any of your clients have family trust elections? So we're just going to give you a couple of moments to answer that question. Hopefully you're able to access it. But for Greg and Yina, FTEs can obviously be incredibly useful. They protect franking credits and reduce exposure to integrity rules around trust losses, but they really do come with long-term consequences and strict rules about who can receive income. And I can see in the poll that the majority of the responses there that people are affected by these rules, right?
Yes.
So can you explain what is a family trust election? And for today, most importantly, where do they actually fit into year-end tax planning purposes?
Yeah, well, I'll try to explain what family trust elections are.
It's a nasty topic.
Good luck. But family trust elections are not something that is provided for within a trustee typically. They are actually prescribed within the legislation, within the Tax Act. And they prescribe certain key elements of what an election constitutes. It needs to be in writing. It needs to have what is a test individual nominated under that election. And that's probably the one that everyone is familiar with. If they weren't before, they're certainly well and truly familiar with it now. So they need to nominate someone that is typically seen as associated, the person most closely associated with the group, with the broader group of family trusts. And you make this election in order to satisfy or meet certain other expectations or requirements within the Tax Act. And most commonly, that is trust losses, even company losses, and the utilisation of those losses. It can also extend to utilisation of franking credits, and it plays a role there as well for certain trusts that might hold shares. And so you've got these requirements that really force you often to make these family trust elections. But then, of course, the issues are that they can come with a lot of, shall we say, legacy issues along those lines if you make those elections.
Yeah, absolutely. So for the purposes of year-end tax planning, it's really about taking stock of what the FTEs are that you have in the group and understanding how that does impact if you make distributions.
Absolutely. Yeah, it's tied in with distributions because family trust elections, I talked about legacies and that they do come with some issues. It's that they then act as a restriction on the family trust. So I talked before about why it was you might want to make a family trust election, but also within the Tax Act are some very clear punitive rules around what happens if you've made an election and then you distribute outside of what is considered the family group. The family group is also defined within the Act, and that covers anyone who then is associated with that test individual that we've talked about. And that association, again, is prescribed very clearly within the Act. So when you're coming to your distributions at year end with one of these family trusts that's made an election, you have to look very closely at whether the beneficiary that you're distributing to actually is considered to fall within the family group. Otherwise, we have what's known as the family trust distribution tax issue.
Absolutely. And Yina spoke earlier about putting in the TFNs for beneficiaries. Obviously, as part of the statement of distribution this year, it's not mandatory. The following year it will be. And that just goes into the ATO's data matching program, right? That's going to be very easy for them to pick up.
Yes.
Speaking of ATO activity, we've seen the ATO come out with website guidance recently in relation to franked distributions flowing from trusts, specifically through to corporate beneficiaries that may have been recently incorporated.
Yeah.
Why can that go wrong?
Yeah, this seems to be something that the ATO have hit upon in the last, I'll say the last year, but perhaps something that they've noted a little bit about in the back of their minds. There is recent ATO review activity for newly incorporated corporate beneficiaries, and the ATO take the view, which they've published on their website, that in order for a beneficiary to obtain the benefit of franking credits that have flown through a trust, the beneficiary ordinarily needs to satisfy the 45-day rule, or the at-risk rules, or the qualified person rules, however you would like to term them. So Greg mentioned that FTEs are one of the ways in which trusts ensure that beneficiaries actually get access to the 45-day rule and satisfy the 45-day rule. But what the ATO have said is that their view is that 45 days starts for on either side of the payment of a dividend date, and the beneficiary of the trust actually needs to have been in existence at that date, and therefore have held the share, or be deemed to have held the shares for 45 days post that date. So you get into this very odd sort of scenario where a trust may have held the shares forever and a day, right? They'll get a dividend. The trust will receive a dividend that was, let's say, paid on 1 January. And then at 30 June, or sometime just prior to 30 June, there's a new corporate beneficiary incorporated, and the trustee determines to distribute the dividend income to that corporate beneficiary. In that particular case, the ATO's current published view is that corporate beneficiary has not satisfied the 45-day rule, and therefore is at jeopardy of losing benefit of the franking credits to that distribution. So it is something to be watch out for. That's the ATO's published view. I don't believe it's currently yet been tested in the courts, but as we're talking about year-end planning, it's probably best to be safe than sorry. So if you are thinking about incorporating new corporate beneficiaries, make sure that any intra-group dividends that you're able to control are actually paid after that corporate beneficiary is incorporated.
Yep.
Continuing on the theme of sort of integrity risks and the ATO's new views, Section 100A continues to be an integrity focus after the release of the PCG a few years ago. What are the practical risks areas that you still see in current arrangements?
For mine, I think it's the failure to recognise that merely distributing to another beneficiary and leaving that as an unpaid entitlement, irrespective of whether you've then had some more overt gifting back or transferring the funds to another family member, simply the fact that it's retained within the trust and potentially not used for business or commercial purposes can be an issue that still comes up. But the one to obviously watch out for, because 100A after all is about contrived arrangements where the person on paper who was beneficially entitled to that income actually never really benefits from it, and that there's a clear evidence of someone else or another entity actually having access to or benefit of those funds, including the trust itself that purported to make the distribution. It is about keeping in mind what the tax office has as the compliance guidance for this, and I think it's PCG 2022/2. Thank you, Chanel. That imposes or provides guidance as to what are considered green zone behaviour and red zone behaviour. Red zone behaviour is the kind of behaviour that we just talked about. It might be that distributions are made to a minor, made to a young adult who enjoys the marginal tax rate relief. They then gift that money perhaps to their parent, for example. It also will cover issues such as where you distribute to a lost trust. It stays as an unpaid entitlement and then is loaned out interest-free to another entity, again, perhaps to the controller of the group. Now, green zone arrangements can be manageable, so you can achieve green zone arrangements. Things like an unpaid entitlement, which is then put on Division 7A loan terms as between the beneficiary and the trust, to show that the beneficiary is still actually enjoying the benefit of that distribution because they're getting a genuine economic return on that entitlement. So that's one example.
Yep.
Any other examples, Ian?
I think it'd be the most obvious one is the payment of that entitlement within 2 years.
Within 2 years.
Yeah. So if they make them entitled, they've got 2 years to pay, and as long as you pay within that 2 years, the ATO says that you're good.
Yeah.
You spoke about those red zone arrangements. I think the other one to mention is that the taxpayer alert that came out in hand with that PCG, which was about the minors. So you specifically called out the young adults, but specifically minors with distributions to those that were set off against sort of distributions to young people that were set off against expenses that they occurred when they were minors, that things that weren't really their responsibility. So things like high school expenses, private school expenses, that continues to be a no-no. And there is a specific taxpayer alert that came out with those that it's definitely a watch-out area.
Yeah, correct.
We can't speak about trusts without speaking about the announcements in the budget. They represent probably the most seismic shift in tax space that we've seen in quite a number of years, certainly in the time that I've been practicing, even if we have until the 1st of July 2028 until they apply. How do those proposals influence decisions we're making this year? Maybe to start with, do they influence the decisions that we're making this year?
I think in short, not really. So the thing to be bearing in mind about the announced changes is, I think, number one, don't panic. We don't know, and that's genuinely, we don't know. There were some policy announcements that came out in the budget, obviously. We actually don't know what form they'll take. Government has undertaken to do consultation. So there will be a lot of water, I suspect, to flow under the bridge until we actually have a better feeling for what that will mean and all the questions that I know you and I've had with clients, Greg, and I'm sure everybody else sort of out there is sort of thinking about. But at the same time, it's probably a good time as we're undertaking year-end planning and having a look at groups and trust groups in particular, is to effectively take stock, have an active, rather than going through a normal sort of a year-end planning cycle where for a lot of groups, they might be doing this by rote. This is not their first rodeo, right? But this year you might actually, make some considered or take some time to consider each entity in your group and say, what does this entity do? What is its function in the group? What do its prospects look like in the next 2 years up until 30 June 2028, and then beyond that when these rules are proposed to sort of come in. And that's really more something that prepares you to consider the rules when we do actually know some more details about how they're going to operate. So that's probably what I would be recommending to people, is just to take stock.
And there were some rollovers that were announced in the budget,
Yeah.
But even then we don't have any details, and they're not apparently going to be available until the 1st of July 2027. So we'll all wait for the exposure draft legislation when that comes out, and we'll be able to see what that looks like in detail then.
I'd agree with Yina. I think it's don't panic, don't act too quickly. Everyone remembers the superannuation changes to Division 296 and where it started and where it ended up. And so a lot of people might have had vendors regret in terms of those superannuation changes and acting too quickly.
Yeah, absolutely. Moving to companies now, what are the key housekeeping items that you think you'd want done properly before the numbers are finalised by 30 June?
Bad debt write-offs is always number one of the hit parade for me. Making sure that you've got a bona fide bad debt, that you've demonstrated an effort made to actually recover that debt, and then making sure that you've properly met all of the requirements to be able to recognise it as a bad debt write-off. That means putting in writing, getting it on record that you've actually written it off and that there's a decision being made to write this debt off and no longer seek to recover it. I think that's a key one. Prepayments, again, for corporate business operators, making sure, again, I talked before about making sure you're complying with that 12-month rule for prepayments. Look to other prepayments, not just interest, but you've got also your statutory charges as well that are often available under the prepayment measures. So looking to that as well. As a company, bonuses and accruals, again, another big one for a lot of our clients. They're rewarding their employees. The bonuses are often calculated after year end. That doesn't mean that they can't be deductible in the financial year, provided the formula by which you arrive at that bonus is appropriate, such that you can say that everything that was necessary in order to say that you had a legal obligation to pay that bonus was in place by 30 June. So those are three that come to mind.
Yeah. The other one that's often discussed in terms of sort of companies and housekeeping items is just generally cleaning up the general ledger.
Yeah.
When we say cleaning up the general ledger, what do we mean when we talk about that?
Looking at your related party loans, any offsets, anything that might present a tax exposure. Did anyone say Division 7A? And I know Yina's going to talk to that in a moment. But also looking at things like the other balances in your ledger, such as your PAYG, your wages, your superannuation, cleaning those up so that by year end, you've got a much cleaner balance sheet going forward.
And obviously, it goes without saying that when we say clean up, we're also talking about enacting legal agreements to set off and assign debts. We're not just putting journal entries in for the most part.
Yep.
From what you're seeing in practice, what do you think companies are most often getting wrong in terms of their deductions?
I thought you were just going to segue to me, Chanel, because that's actually the thing that we were really going to say, right? Like, is that we're all, I think, particularly, I'll say with third party things, companies are usually pretty good, but on the documentation front, it's really the related party transactions, services that kind of get put to the wayside because, that's all us. We can deal with all of that. And really that's not, I guess, best practice going forward anymore. So recently we have the federal court case of SNA Group where the court came down pretty harshly on the lack of documentation of services that are provided from one entity in the group to the other and what that meant for the deductibility of those service fees for the entity supposedly receiving those services. So those are the things that we would basically be recommending to all of our clients to say, make sure it's documented. All your interest bearing loans or non-interest bearing loans between group entities, make sure that they are actually documented so that you've got something to hang your hat on other than journal entries, because journal entries can be made post-year end. They are not evidence of transactions that have happened purportedly before 30 June. So yeah, the documentation, I think, is the thing where a lot of people will still get wrong, but hopefully we're getting better at that.
And I think people often fall into the trap of thinking that they're the one controlling mind of the group, and therefore they know what's been agreed.
Yes.
But it's about being able to demonstrate that to the ATO when they eventually come knocking.
Yeah.
The other thing that quite often comes up is bad debt deductions, and we talked about writing them off.
Yep.
But some of the traps that people come into with bad debt deductions.
Yeah, bad debt deductions is a really good one. So as Greg you were saying, is that you do have to make a decision to write that off before 30 June. Now, how you document that is then also important because a journal entry is not necessarily evidence of that. So we would generally recommend to clients to either put it in a director's resolution, put it into a note, something that actually says, here is the decision that I've made and here the decision was made before 30 June.
Yeah, and making sure that you're only writing off or not writing off, but you're only claiming a deduction for something that you've already included in your assessable income is probably the one that we see a lot as well.
Yep.
So you can't claim a deduction for something that you haven't included beforehand.
Yep.
Div 7A continues to probably be a key focus area for private groups this year, as much as we wish it didn't. It's always been a moving target, but right now the biggest source of uncertainty is Bendel. And how the ATO will ultimately respond. So before we get into that, we're going to just take a quick poll again. And I was just waiting to see, I didn't write down what the poll question was. Does Bendel impact your 30th June 2026 planning for this year? Obviously, the Bendel decision, the court hearing was, I think, in December this year. So we're going on 5 months since that. So I think we're all sort of silently hoping that it comes quickly, but also maybe not too quickly. Maybe it's not enough time for us to consider pre 30 June. Maybe want it after that. It seems like there's quite a large proportion, maybe 2/3 of the group, that actually it doesn't impact their 30 June 2026 tax planning. So for a Div 7A perspective and thinking about Bendel in particular, what should people be considering at the moment?
Yeah, and I just realised I'd actually dobbed Yina into actually responding to this question when it's actually one. Yeah, and Freudian slip. And Yina, feel free to jump in going forward. But so year end again, 30 June, Division 7A is heavily influenced by 30 June. So it's about getting in early and identifying those Division 7A exposures that are going to be there when you're looking at that 30 June balance. And so that includes not just loans that have been made, but look out for payments. Consider if there's been any debts forgiven, use of assets, all of those things come 30 June. If you're identifying them, then you need to be thinking about what, if any, actions need to be taken. Minimum yearly repayments is a big 30 June milestone, and it's been such a big deal for our clients for the past 20 plus years now, is making sure that they can meet that minimum yearly repayment, either that they can lay their hands on the funds to meet that minimum yearly repayment, or that they can appropriately document what is a legally bona fide payment by way of a loan set-off and make sure they've got that in place by 30 June. All too often as part of the year-end planning, it might be in those last 2 weeks that you're identifying these things. You've still got to then get the documentation in place to actually be able to fix it. So you agree with that, Yina?
Yeah, no, definitely, Greg. And the only point I would probably add to that is that we are seeing the ATO focus on methods of repayment.
Yep.
So in a lot of our interactions with the ATO for over the last sort of 12 to 18 months, the question does not now stop at, did you make a repayment? It's, how did you make the repayment?
Yeah.
Right. So that documentation will be critical in demonstrating that were the ATO to come knocking. Similarly, the ATO are increasingly focused on borrowers who effectively re-borrow from the lender in order to make their repayments.
Yeah.
So we all know that it's not permitted to re-borrow from the same lender or the same company in order to make your MYRs, but the ATO are also now increasingly focused on re-borrowing potentially through interposed entities to make that MYR. So again, documenting that flow of funds, where the cash came from, whether you've got offset documents or assignment documents to show all of that will put you in, I think, much better stead in the going forward into the future.
Yeah, but can I make a suggestion? So a bank account of an individual repaying their Division 7A loan that shows 30 June, the funds going out. And then when you look at that same bank account on 1 July, the funds coming back, that's one that probably people should avoid doing. I have seen that in the past.
Yeah.
I'd strongly recommend against it. But we've got a decent rate now, interest rate that's now ticking up. So again, we're back to those higher rates. I think it's 8.37% or something along that, around 8%.
Yep, 8.37.
Yep, and also we've got our sub-trust arrangements. So it's not just our conventional Div 7A loans. We need to be thinking about our sub-trust arrangements, and those sub-trust arrangements that are eligible to then move on to a Division 7A loan as a bona fide refinance. Be careful, make sure that you are making that minimum yearly repayment, that first minimum yearly repayment in that year that you're doing that effective refinancing to the Div 7A loan.
And I think it's 2017 sub-trust arrangements that their MYRs are due this 30 June. So paying particular attention to those.
Correct.
You mentioned assignments in the context of set-offs and assignments. I think one of the things that I noticed most often that people forget or overlook is debt parking arrangements.
Yes.
If you are assigning loans, is there any other watch out that people should be thinking about? Yina?
Yeah.
We've been doing a lot of assignments lately, so
yes. Yes. So I think it's quite important if you are considering assignments and set-offs to meet your MYRs is that you actually understand the transactions and actually consider all the tax implications that actually come from those transactions. So yes, the ultimate goal of them may be to meet your minimum yearly repayment, but at the end of the day, there may actually be capital gains tax consequences. There may be commercial debt forgiveness consequences. So you talked about debt parking, Chanel.
Absolutely.
That is one where even though it doesn't look like it's a forgiveness of a debt, the tax law will potentially treat it as the forgiveness of a debt. So making sure that you understand each step of those transactions. Yes, we know the end point, but each step along the way can have tax consequences. So make sure you consider them carefully.
Yeah, absolutely.
Yeah.
And
sorry.
No, I was just going to say debt parking is exactly what it sounds like, right?
Yes.
You're just moving a debt to another entity that you're aware is never going to call on that debt. So you're just parking it there. And the ATO says, well, you may not have forgiven it, but you've forgiven it.
Yes.
Yeah. And maybe there was a genuine intention ultimately to repay it, but if the fact is that in the interim, it's sitting there and the evidence points to there being no clear requirement to repay it, then you're definitely at risk. Making sure that you've got that documentation right as well for those assignments. So it needs to be an effective legal assignment, and that might be also that you need to consider that it's a tripartite agreement where you've got the actual debtor themselves acknowledging that their debt's being assigned for it to be considered legally effective.
Absolutely. The instant asset write-off always gets a lot of attention this time around. After being temporary and extended year by year for almost, or actually more than a decade, the government has just announced in the budget that they're going to make that permanent. What does that mean for businesses this year?
Yeah, I think it means that the scramble kind of can stop. It's not a do or die kind of scenario by 30 June. But at the same time, in the context of tax planning, if it's an expenditure that you have already planned on and intend to make, then an earlier deduction is always a better deduction than a later one. So the thing to perhaps watch out for with instant asset write-off is that you can't have just spent the money. The asset needs to have been installed and ready for use. So if you're waiting for something to be delivered, if you're waiting for something to be constructed, just be mindful of that lead time and ensure that it's actually in place and ready for use by 30 June.
Yeah. You can't just have bought the printer and leave it sitting in your box. You actually taken it out of the box and plugged it in.
I'll remember
you,
that.
Greg.
Yeah, tip for Greg personally. We've spoken a little bit about franking in a trust context, but from a company perspective, where do you see businesses getting dividends and franking either right or wrong?
Yeah. So there's a phrase that we've been using in recent years, the base rate shuffle, which I love, and I know you enjoy it as a phrase as well. But this is the issue we now find ourselves in ever since they introduced the differing corporate tax rates, and their solution is less than ideal in terms of how we manage that, in terms of how it was legislated. So bottom line, you can have a mismatch when you're paying dividends out in any given year out of your corporate. You can have a mismatch between what the franking rate is that you're attaching and what the corporate tax is that you're actually paying in that year. Because the way these rules are drafted is that the franking rate that you can apply to your dividends is driven by what the corporate rate was that was applicable the previous year. Now, we've got two rates, 25% for your base rate entities, and then we've got 30% for all other companies. And so your base rate entities, which have active businesses, they can enjoy that 25%. And so it might have been a base rate entity in 1 year, but perhaps the next year it becomes a passive entity. Maybe it sold the business in the previous year. The issue there might be that if you go to pay your dividend and you've got insufficient franking credits, then you might find that you have over-franked to the extent of what is in your franking account, and therefore you'll have a franking deficit issue. So then you can have problems with franking deficit tax. So that's the issue and the challenge that you can have. Also, when you flow from one corporate through to another corporate, you might find that you've got a mismatch in those rates. So you've got one corporate that is franking at 25%. That's what it's forced to do. It flows through to a passive company, which is or a company that has low income, which pays tax at 30%. And so again, there's top-up tax paid within your corporate environment. that you weren't anticipating. And then putting that to one side, there's just the normal compliance considerations. If you want to make sure that you've effectively franked your dividend and that the individual or the shareholder, whoever's receiving that franked dividend, can recognise the credits, you've got to make sure that you've complied with your distribution statements being recorded at the right time.
Yeah. And in addition to the top-up tax and, franking deficit tax as well, you at risk of your franking credits essentially being trapped in one entity if you don't get it right. So it is very important to take stock of what your entity is and really understand what your tax rates for those years are. With the removal of the deductions for general interest charge and shortfall interest charge from the 1st of July 2025, so it did apply from the start of the income year, what practical steps should people be considering now as part of their year-end tax planning?
Yeah, definitely. So this FY26 is the first year that GIC and SIC are no longer deductible. So
1 year anniversary.
I wouldn't call it an anniversary, Greg. Not to be celebrated, I think. But I think in the context of year-end planning, it might be something that, it's not a tax adjustment that a lot of people have had to make. So just be mindful that if you do have GIC or SIC in the current year, is that you plan that will be non-deductible when you're, forecasting what your tax will be for FY26. As I think we've been telling a lot of our clients throughout the year, is that as it's no longer deductible, it's effectively now a penalty. Yeah. So you want to try and minimise that as much as possible. In prior years, there may have been people who've thought, it's, we can probably arbitrage the rate a little bit. I could get a better return on my investments than perhaps the ATO will give me on a GIC rate. Well, now you can sort of uplift that rate because the effective tax GIC rate will be a lot higher given that it's no longer deductible. So changes the mix a little bit. So we would be saying we have been and would say to a lot of our clients, make sure you're aware of what your tax debts are. You were talking about franking deficits tax, Greg. That often, in my experience, gets missed because if a company goes into franking deficit, the franking deficits tax return is due 31 July. And there may be a liability for franking deficits tax from 31 July. Now, if you don't know that, then that debt will continue to accrue GIC non-deductible, right, for the period until you realise that your franking account's in deficit. So it's just being mindful of a lot of these things, being on top of all of your tax accounts. Make sure you have access to the business portal. I know that it's a pain, but it is important in the context of trying to minimise any non-deductible interest to the ATO.
Yeah.
And I think the final question from me before we talk to some of the questions that are coming from Slido, and I'll turn to each of you in turn. If you had to give one piece of advice from clients, just one, the week before 30 June, what would it be?
My advice would be don't be doing this the week before 30 June. Get in 6 weeks before 30 June. Have your year-end planning meetings occurring in May going, if you can. We're already past mid-May. We're almost into June. Have them now. Make sure that you've identified all of your year-end issues now so that you can get your documentation in place. And that's not just Division 7A, that's trust distributions as well. There's a lot of thought that has to go into the planning around these to make sure you get them right. And that will require time. And then the documentation will require the time. So make sure you get in early.
Yeah, absolutely. And Yina, your one piece of advice?
Yeah, no, the documentation piece definitely is too often. I think a lot of people will go through, they'll take Greg's advice, they'll get in early, they'll do all the planning, they'll do all the hard work, and then they'll fall over at the last hurdle because they haven't gotten their documentation in place. So you don't want to do all that hard work only for it to come to naught if the ATO were to come knocking on your door a couple of years later and go, where's this piece of paper? And you're like, I did it.
Yeah, that's right. And get it right. Get that documentation right. Yeah,
definitely.
Great. It's certainly a lot to think about. I think a few of the consistent themes are quite obvious when we talk about them. Obviously, timing really matters, particularly if things need to be done before 30 June. They need to be done and evidenced before 30 June. Documentation and evidence are critical, right? It's about making sure that's what's done can be supported later. And the other thing that I picked up from this is that there's continue to see a strong focus from the ATO about integrity as well. So it's just important that making sure that your arrangements actually reflect real commercial outcomes, that they're not just about year-end tax adjustments. Ultimately, from my perspective, I think good year-end tax planning isn't just about identifying opportunities. It's really about getting those fundamental things that you do year on, year out, getting those things right. So we'll move to a couple of the questions from the audience. I think we do have a little bit of time. The first one that's come through is, if the test individual dies, in the context of a family trust election, if the test individual dies, is that a problem? And if so, why?
Well, I don't see it as a problem if the trust election is already in place. It's a problem if you haven't got the trust election in place yet. And often people might confuse the benefits of an interposed entity election versus the benefits of a family trust election. I'll try not to get into too much of the weeds here, but so let's focus on the original question. Your test individual, if they pass away, that is only a problem for future elections that you're thinking of making, not the one that's currently in place. Once that's in place, that's there forever. It's not an issue if the test individual passes away.
Yeah. It's one of the problems that we've seen a little bit in practice in the past 12 months is probably when you have done one of those FTEs and you do have it, and then the test individual dies, you can't make any future ones. And so the future ones that you need to be with a different test individual. And then you do run into problems because you've got two trusts that are within your group but can't be within the same family group. So it can be a very significant problem. And I'd say you'd be recommending that you take very good stock of who you want that test individual to be. Obviously, we can't predict if you get hit by a car one day, but giving it as good a shot as you can.
Yes.
The next question that we've been asked is, will FTEs be relevant even under the budget proposals?
I'm sensing a common theme here, Nico. Over to you.
Yeah, maybe. We don't know. So there's a part of me that actually thinks that some of the benefits of FTEs may be eroded quite a lot by what's being proposed as a minimum tax on trust distributions. There's a part of me that actually potentially thinks that using FTEs to flow through franking credits to beneficiaries may be a thing of the past as well. If the idea is that beneficiaries don't get franking credits, they get some other type of tax offset.
One less reason to force you into making a family trust election.
That's right. So the short answer is we don't know, but as somebody said to me, I think in one of our sessions, in discussions in the last week, is maybe there's a silver lining to this 30% trust tax thing. So can only live in hope.
Ever the optimist. Yeah.
Take a 30% trust tax and have to get to forget about family trust elections, possibly. Well, thanks everybody for your questions, and thanks to Yina and Greg for your answers today. We'll be sharing a recording of this webinar along with a more fulsome slide pack for you on Monday that will have some additional resources and some of the points from our discussion today. As always, should you have any questions or wish to discuss today's session in more detail, please contact your normal Pitcher Partner contact. I think both Yina and Greg's contact details as well will be circulated on Monday as well, so they'll look forward to receiving your calls and emails. And for more information or to stay up to date with everything that we've discussed, you can always access our website as well. So thank you.